Hi there, very good morning. Welcome back to ET. Now you're watching Market Cafe with me, Kanishka Sarkar. Over the next 1 hour, we'll take you through all the global and domestic cues that you must watch out for and also tell you about the stocks that you need to keep on your radar today ahead of start of the trading session on D Street. But let's get started with an eye on the globe first and see how the Wall Street fared overnight. And US markets did finish yesterday on a higher note. It was supported by softer than expected ADP jobs data that actually boosted hopes for a Fed rate cut next week. The Dow jumped over 400 points, that's up nearly 1%, whereas the S&P 500 that also added about 0.3% gains. Nasdaq, on the other hand, that closed about 0.2% higher. Now, in terms of after-hour trading, Salesforce climbed more than 5% on strong revenue outlook, and Five Below that rose nearly 2% after posting earnings that topped expectations. Now let's talk about the jobs report. Now this ADP report showed a surprise drop in private payrolls for November. That's pushing the market pricing for a December 10th rate cut to nearly 89%. But despite this optimism, the AI trade that remained shaky. Tech was the weakest S&P 500 sector, with Microsoft, Nvidia and Broadcom, all of them under pressure. Microsoft, in fact, slipped 2.5%. This after reports about lowered AI software target claims. Now, this company later refuted these claims. However, the stock did end about 2.5% lower. In fact, strategists note that the rotation away from big tech and into defensive sectors, that is marking a potential early sign of risk aversion. And also, investors are watching developments on the Trump administration's tariff agenda after comments from Treasury Secretary Scott Bessent at the Dealbook Summit. In terms of what to watch out for, of course, there's the next week's Fed meeting, continued sector rotation signals, tariff policy updates, and whether tech can really regain momentum. So yes, that's about the Wall Street, but let's also tell you what's happening as far as the crude market is concerned. And oil prices did bounce back yesterday, rising more than 1%. That's after Moscow confirmed that peace talks with US officials brought no breakthrough on a potential Ukraine deal that's keeping sanctions on Russian oil firmly in place. And on the back of these developments, Brent crude climbed to above $63 per barrel, whereas the WTI rose past at $59 level. In fact, geopolitical tensions also flared after Ukraine struck oil export sites and sanctioned tankers in the Black Sea. That's adding fresh supply worries. So yes, these gains were capped by a surprise rise in US crude and fuel inventories as well. That's about the crude move, but let's also put the spotlight on the yellow metal and see how gold did. Well, it held pretty steady, supported by weaker than expected US private payroll data with strengthened expectations of an interest rate cut. Like I mentioned before, spot gold that hovered around that $4,200 an ounce mark, whereas silver that actually hit another record high, driven by supply concerns and overall strong demand. So yes, safe haven metal stayed firm as rate cut hopes and geopolitical uncertainty. All of that is keeping investors cautious about the equity markets. So yes, that's about the Wall Street and commodities check. But let's get started and take you through some of the top global stories that we are tracking this morning. And first up, let's discuss US's private payrolls data. Now, the labor market cooled sharply in November as private payrolls fell 32,000, driven entirely by steep cuts at small businesses, according to ADP. Now, firms with fewer than 50 employees shed 120,000 jobs, while larger companies added about 90,000 jobs. Now, this report lands just days before Fed's December meeting, where traders still see about 90% chance of another quarter-point rate cut. Policymakers remain split between cushioning a softening jobs market and avoiding fresh inflation risk. Now, all eyes are going to be shifting towards the delayed non-farm payrolls report, and we'll watch out for how that pans out. Moving on, Scott Bessent has said that Trump administration could recreate its full tariff regime even if it loses the pending Supreme Court case, citing broad presidential powers under multiple sections of the 1962 Trade Act. He argued that certain sections provide enough authority to replicate the structure. Now, Bessent still believes that US has a strong chance of winning the case, and separately he sidestepped questions on Trump's pick for the Fed chair position, noting that the chair is only one vote on a wider board. Well, let's keep it going with Fed data. Then now new data suggests that central bank has stopped losing money after 3 years of unprecedented losses tied to its pandemic-era bond buying. And since early November, the Fed's deferred asset, the accounting bucket that captures cumulative losses, has slightly edged lower. Economists are also saying that Fed could post over $2 billion in combined Reserve Bank profits this quarter that would be held by lower rate payouts as easing begins. Now, let's move on and get you some more corporate updates on the global front. And Salesforce, that has posted a solid earnings beat and offered a stronger than expected revenue forecast, even as overall sales narrowly missed consensus. The company banked over $500 million from its Agentforce AI suite last quarter, underscoring its best on automation. Now, despite new AI-focused acquisitions and a bold $60 billion revenue target for FY30, the stock has trailed big tech this year. Moving on, let's get you some more updates on immigration. Now, the Trump administration has paused all immigration applications, including green cards and citizenship filings, from 19 non-European countries, citing national security concerns. Now, this list mirrors nations already facing partial travel bans, including Afghanistan and Somalia. And this move follows last week's attack on National Guard members in Washington, for which an Afghan man was arrested. Moving on, Union Secretary General Antonio Guterres said that there is something fundamentally wrong with Israel's military campaign in Gaza, citing total neglect of civilian deaths and widespread destruction. He said that there are strong reasons to believe that war crimes may have been committed, even as Gaza counts more than 70,000 dead in two-year conflict that was triggered by Hamas's 2023 assault on Israel. Guterres added that Gaza is devastated with Hamas, while Hamas remains intact. Moving on to the big story of the day then, Putin will land in New Delhi today for 23rd India-Russia annual summit. Russian President Vladimir Putin's visit to India this week aims to secure energy supplies, stabilize defense deliveries, and ensure bilateral trade continues smoothly despite strong Western sanctions. GTRI said, that's the word coming from GTRI, and Sumita is also here to tell us all that's on agenda ahead of Putin's meeting later today.
That's right. In just a few hours from now, Russia's President Vladimir Putin is touching down in India. Anticipation hangs thick in the air here in the national capital, which is bracing for a high-stakes visit, which is loaded with symbolism, strategy, and a touch of suspense. After all, it's something that the whole world is watching closely. So what really is on the agenda? We have the tentative plan of President Putin's India visit. Today, late afternoon, he arrives and then he holds restrictive talks with Prime Minister Modi at his residence. There's also likely a private dinner that will happen. Tomorrow is when President holds talks with Prime Minister Narendra Modi, and of course India and Russia Business Forum is also on the agenda, and a banquet later on with President Draupadi Murmu. But let's also understand what really is on the agenda, given the fact that this visit is happening in the backdrop of disruption across the globe on account of Donald Trump's tariffs. There is, of course, a Russia-Ukraine war. Even though both sides are looking at arriving at a peace deal, the conversation will touch upon these matters of geopolitical and international importance. The 25% US tariffs due to energy trade with Russia that the United States imposed on India, that could also find some sort of discussion or talks. As far as defense is concerned, well, the acquisition of S-400s and Sukhoi 57, that could be also a part of the talks that will happen. However, government sources have suggested that there will be no deal that will be signed as of now. However, the Russian side did indicate at a press conference day before yesterday. Then, of course, small nuclear reactors is something that Russia is looking at cooperating with India on. But this is a very crucial visit. Why? Because it's the first visit that President Putin has undertaken after the Russia-Ukraine war altered global alignments. In fact, Dmitry Peskov, a spokesperson of the Kremlin day before yesterday, he did mention that sanctions are illegal. Russia considers these sanctions illegal, and that Russia is looking to ensure that trade with India continues. Now, speaking about trade, definitely there is a huge deficit, and that's been also acknowledged by the Russian side as well. It'll be interesting to see the kind of possibilities that there are that the Russian side is looking at with respect to imports from India. So overall, there will be cooperation review of defense, of nuclear energy, of space, technology, connectivity, given that INSTC expansion that gained pace on new freight. So all of these very, very crucial points to look forward to, and of course we'll have to wait when the president arrives.
All right, thank you, Sumita, for bringing us all of those details. We'll keep coming back to you through the day to get us all the latest updates on Putin's visit to India starting today. But on that note, we need to slip into a very short break. We'll be right back with more on the other side. Cafe with me, Kanishka Sarkar, and it's time now to take a look at how the Asia-Pacific markets have opened up. And it's a rather mixed day coming in after moves that we saw on Wall Street yesterday after the rally on the back of softer than expected jobs data. So let's see how the Asian indices are faring. Shanghai down absolutely flat over there, 0.1% decline, trading at that 3,873 level. Hang Seng as well, Hong Kong's index nearly flat, 0.2% downtick over there, 25,700 is where the index is at. Nikkei, strong's move on the Japanese front. Japan's index Nikkei, that's trading nearly 1.5% higher right now, above that 50,500 level. So yes, strong moves over there. If we talk about South Korea's Kospi index, that's actually the one that's trading in the red today. It's down nearly 1%, trading just above that 4,000 mark. So yes, just holding on to that 4,000 level on the Kospi. Now let's also put the spotlight on the Australian index, that is S&P ASX 200. That's also trading absolutely flat in trade today. However, managing to hold on to that shade of green, trading close to that 8,600 level. So yes, that's about some of the Asian indices. Now let's also talk about Nifty, which yet again ended just below that 26,000 mark, couldn't hold on to that level. And today as well, a negative start is what is being penciled in. The Nifty implied open suggests a 57 points of decline at the start. So yes, a slightly negative day is what we are penciling in. A negative start, 0.2% downtick over there. For the D Street is what we are expecting at open. But how was trade yesterday? Which are the sectors that were on the move and which are the ones that led to the declines on Nifty that we saw yesterday? Sneh is here to take us through that entire market roundup.
Well, yes, yet another tepid day of trade for the market. Nifty has ended with a cut of a further 0.2%, but below the 26,000 mark. So that is something that we have failed to achieve. So watch out for that. And when we are able to scale that part, because the BSE Sensex expiry is going to be an important day to watch out for as well. For the Sensex and absolutely flat around that 85,100 mark. It was Nifty Bank that made its dash back to the green towards the day's close, and about 0.2% uptick coming in the Nifty Bank. The India VIX was also absolutely flat, didn't do all that much. But if you take a look at the advanced decline ratio, steeply in the favor of the declines, and that was the trend throughout the day. A 1:2 ratio in terms of the advances to declines. So yes, the declines were weighing heavy. On the back of that, the market breadth overall was quite weak. You had the Nifty mid cap that was lower by about 1%. Nifty small cap also not too further behind, 0.7% cut on the small cap index, and these largely underperformed. Both of these indices largely underperformed the benchmarks as well. But if you take a look at the Nifty 50 gainers and losers, it's Wipro, TCS, ICICI Bank, Hindalco, Infosys, HDFC Bank. So private sector banks and IT, large cap IT names to be particular, did very well. On the flip side, some pressure on the Nifty from Max Health, lower by about 3%. Tata Consumer, Adani Enterprises, BEL and M&M were the stocks that didn't do all that well. Sectorally, it was the day of the IT stocks, because remember, while the market was reeling under pressure due to the weakness in rupee, wherein the rupee hit its all-time low, you also had the IT space on the flip side. That was the only sector that was rejoicing on the back of this news flow, because it makes the dollar more attractive for IT companies in the US that place orders with Indian IT companies. On the back of that, IT did very well, above 0.8% higher, with Wipro, TCS, Infosys, Emphasis, Tech Mahindra, all of these stocks doing very well. Followed by that, you had financial services and Nifty Bank that ended with some shred in the green. On the flip side, pharma on the flat line, with metal, realty, FMCG, energy, auto in the red, and of course Nifty PSU Bank, the top sectoral loser. A 3% cut coming in on Nifty PSU banks on the back of the word coming in from the finance ministry that they are not looking at hiking the FDI ceiling for public sector banks. There's also not going to be any nationalization of the private sector or the privatization of the private sector banks that we've seen. So public sector banks. So yes, that is something to watch watch out for. Those are some comments coming in, and that had a deep impact on the PSU banks. But overall, on the breadth of the market, if you take a look at some individual gainers and losers, DOMS was up about 4.5% on the back of a good brokerage initiation coming in. On the flip side, you had Indian Bank, Angel One on the back of weak November numbers coming in, Ola Electric and Wockhardt that saw some profit taking. So yes, that was the breadth of the market and the way we ended. All eyes are going to be on what the market does on the BSE Sensex expiry day.
All right, so yes, a very tepid day is what we saw yesterday, and today also that we are likely to follow suit. It's likely going to be a mild day. But which are the stocks that could be on the move? Ashesha is here to take us through that list. Ashesha, good morning.
Good morning, and first up, let's talk about all the Good related stocks. The likes of ITC, Godfrey Phillips, VST Industries will all be in focus today, and this is because the Lok Sabha yesterday passed Central Excise Amendment Bill to repurpose levies on tobacco products. And remember, this is ahead of scheduled phase out of GST compensation that has been levied on them. So on the back of that, on the back of this bill that was passed by Lok Sabha yesterday, all of these stocks will continue to remain in focus today. Meanwhile, JSW Steel, on the back of that transaction which the company announced yesterday during market hours, remember there are some more details which have now emerged, and the management of JSW Steel has now said that their net debt will come down by nearly 37,500 crores on the back of this equity investment that has been done by JFE Steel. So on the back of this transaction, positive news flow coming in for JSW Steel. Meanwhile, Bank of Maharashtra, important update has come in with respect to their OFS, which was open for the last two trading sessions, and Deepam Sekhi has said that it was oversubscribed by nearly 1.76 times. The interest that was seen in OFS was very strong, and the bank is now complying with minimum shareholding requirements of SEBI. So Bank of Maharashtra, on the back of that strong subscription data that came in from OFS, will continue to remain in focus for the third consecutive day today. Interglobe Aviation, meanwhile, on the back of flight disruptions, will be in focus. Some bit of negative reaction is what we could see. Management has said that operations are likely to be disrupted over the next 48 hours as well. Unforeseen tech glitches, weather and new crew rules have triggered disruptions, and this perhaps could weigh heavy on earnings in this quarter. ZF Commercial Vehicle will also be in focus, and there is a positive news flow over here where they have secured ADAS, which is Advanced Driver Assistance System nomination from an Indian mobility commercial vehicle OEM. So positive development coming in from them, and ZF Commercial will also be in focus on the back of this.
All right, thanks Ashesha for that list. But several other stocks that are going to be in the spotlight today. And let's start with IEX, this one, because November electricity trade data is out, and the traded volumes have come in at 11.41 billion units. That's up more than 7% on a year-on-year basis. So yes, a positive news flow here. Other than that, we'll also talk about Whirlpool India, which is going to be in focus because it has received a GST demand penalty and interest of 100 crore rupees on December 2nd, and the company has notified the exchanges about it, and hence there's a negative news flow here. We'll watch out for how the stock reacts. Next up, let's put the spotlight on Petronet LNG. This one has signed a pact with ONGC for ethane unloading, storage and handling for a period of 15 years. So yes, yet another positive news flow here, and we'll wait how the stock reacts to this development. Next up, again, Oil India is in the focus. This one because Public Enterprises Department has granted its Numaligarh refinery Navratna status. So yes, a big positive development here, and we'll wait how the stock reacts to this latest announcement from the company. And lastly, we have RVNL, this one on the back of a big order win. It has received a letter of award from Southern Railway. It's worth 145 crore rupees, and hence this one is also to be in focus. A rather positive news flow here. So yes, all of these counters are the ones that we'll be tracking in today's trading session. Well, that's about some of the stocks that are going to be in focus today. But with that, we'll slip into a short break and be right back with more news and updates on the other side. Has also acknowledged about the flight disruptions and said that a combination of factors has severely affected flight operations. Samir is here to take us through all of those details.
India's largest domestic carrier, Indigo, has been facing a widespread flight cancellation and delays for the past 2 days. And Indigo, in its official statement, has also acknowledged that there are several factors which has resulted into the flight disruption. But the details that Indigo has shared to the aviation regulator, DGCA, mentioned that over 1,230 flights has been cancelled. In addition to this, the largest factor that contributed for the massive flight cancellation was the crew or the FDTL constraint. Now, this FDTL is flight duty time limitation, and that led to 755 flight cancellation. In addition to this, there were other factors as well, like the ATC congestion and the airport restriction as well. When it comes to the airport restriction, that led to 258 flight cancellation, and the ATC system failure led to 92 flight cancellation. Now, this has significantly brought down the OTP, the on-time performance of the airline. For the month of October, it was 82%, which has dropped to just 67.70% for the month of November. This is the reason that now DGCA has stepped in, and DGCA is investigating the current situation. In addition to this, DGCA has also directed Indigo management to report to DGCA headquarters and to apprise that what are the real reason behind the massive flight disruption and what are the steps that the airline is taking to minimize the problem or the inconvenience caused to passenger. So far, Indigo has mentioned that they are taking a couple of steps. For example, they are strengthening the crew rotating or the planning as per the revised FDTL. They are also looking to enhance the coordination with the ATC and the airport management, and also they are looking to improve the turnaround of the aircraft. So with these sort of steps, they are looking to mitigate the impact. But yes, Indigo has also mentioned that the entire operation to stabilize will still take next 24 to 48 hours, which means that the passengers across the airport in the country will still have to face a lot of inconvenience.
All right, so that's all about Indigo's flight disruption in the past few days. Thanks, Amir, for that update. But now let's shift focus to some policy-related news. The Lok Sabha yesterday passed the Central Excise Amendment Bill. Now, this bill proposes to replace the GST compensation cess, which is currently levied on all tobacco products. The finance minister who moved the bill highlighted that excise duty will ensure tax incidence on tobacco remains same after GST cess ends. Now, Samir is here to take us through all of the highlights of the bill that was tabled yesterday.
The lower house of the parliament, Lok Sabha, passed the Central Excise Amendment Bill 2025 on Wednesday by a voice note. Now, with this, the bill will replace the existing GST compensation cess on products like cigarette, chewing tobacco, cigars, hookah, and zarda with a revised excise duty structure. In the parliament, FM also gave a clarification. FM Nirmala Sitharaman mentioned that the bill does not introduce any additional tax on the tobacco. So that was a major clarification given by the FM. In addition to this, regarding the revenue sharing as well, FM clarified that the revenue which will be collected from the excise duty, it will be redistributed to the states as per the Finance Commission recommendations. So revenue distribution with the state will take place. So there will be no ambiguity or no confusion on the same. The current tax structure, if you see on the tobacco product, it attracts a tax of 28% GST plus the variable cess. But with the new structure coming into place for the unmanufactured tobacco, it would face excise duty of roughly around 60 to 70%. Similarly, for cigarettes, up to 65 mm without filter will attract rupees 2,700 per 1,000 sticks. So this was an important bill that was passed in the parliament, and now government has also clarified that the revenue sharing with the states will take place and there will be no confusion on the same.
Right, thanks, Amir, for taking us through the highlights. But let's also take a look at what Finance Minister Nirmala Sitharaman really had to say about the bill and some of the key highlights over there.
In India, prior to GST rates, annually, rates on tobacco had been increased. So it's primarily health-related concern with which it had to be a deterrent. The price or the tax had to be a deterrent so that people don't get into that habit. But after the sunset of compensation cess, as I said, we are bringing back the excise duty which existed prior to GST.
right, so those are the comments coming from Union Finance Minister. But more updates from ministers. Now, Union Commerce Minister Piyush Goyal exhorted the value of innovation and highlighted the importance of innovation, quality, design, sustainability and efficiency as key drivers of India's manufacturing competitiveness while addressing the India Edge event organized by the Confederation of Indian Industry, CII, that is, in New Delhi. Let's listen into what the minister had to say.
And therefore, the need of the hour is that we focus on innovation, we focus on understanding where the chinks in our armor are. There will be many products where we will need to be self-sufficient. We will need to have the supply chain in our own control, particularly after the way we have seen the weaponization of trade in recent times. It's important at the cost of repetition, and I will have to repeat it many times, I think, because I still don't see that sense of urgency where people are assessing their supply chains to see where the concentration of a geography or a supplier can hurt their long-term survival. And such areas of concern, if we can identify them quickly, if we can plug them quickly, will be essential in our long-term strategies, both to survive and then to grow.
All right, so those are the comments coming from Piyush Goyal. But let's move on and talk about rupee. Now, as the rupee weakens, fresh concerns have emerged for frequent travelers as this could impact airfares, hotels and shopping abroad. Mithali joins us now as she decodes the impact of the weakening rupee on the travel sector.
Right, so the Indian rupee is again at a free fall and it's now Asia's worst performing currency year to date. Against the rupee, the US dollar is up 5.2%, yen is up 6.2%, Canadian dollar 8.3%, British pound is 11% up, and the Swiss franc nearly 19% up. Clearly, the pressure on the rupee is intensifying. Now, what's driving this slide? Let's have a look. So there are three key factors that come to our knowledge: aggressive dollar buying by the banks, continued FIS outflows from the Indian markets, and the ongoing uncertainty around the global trades. All of this has pushed the rupee at the fresh lows, impacting not just the markets but also everyday consumers that are planning the overseas travels. Now, when the rupee weakens, traveling abroad gets noticeably more expensive. Airfares, the hotel stays, also the shopping overseas all rise in cost. And any booking linked to the US dollar or other foreign currencies immediately becomes pricier. Now add higher the jet fuel prices and the global inflation, and travel budgets can shoot up sharply. Now, so what specifically gets costlier? Let's have a look at that. A weak rupee means you need more rupees for every dollar spent. Airfares rise because the fuel imports become expensive. Hotels and resort rates move up due to the forex-linked pricing. And even the shopping and sightseeing abroad cost more because of the conversion fees and also the card charges. So in short, a falling rupee makes your entire trip heavier on the wallet. But travelers do have the ways to manage these rising costs. Using the multi-currency forex cards help lock exchange rates and reduce the fees. So always choose the local currency while paying abroad to avoid the INR markups. And also, booking flights and hotels early can also protect against the sudden spikes. So, what could be the best alternatives when the rupee is falling? Usage of multi-currency forex cards or local currency billing, locking of the forex rates early can also help you keeping your costs under control. So, a weak rupee may make your foreign travel expensive, but with smart planning and the travelers can stay ahead of the currency turbulence.
All right, thank you, Mithali, for that. So travel could become expensive for you. That's the word coming in. But let's also see what experts are making of the weakening rupee. And veteran banker Uday Kotak is blaming foreign institutions selling Indian equities and said that for now they seem smarter as local investors continue their buying spree. As the rupee breached the 90 versus dollar mark yesterday, Kotak said that Indian businesses should be ready to face the impact of Indian rupee hitting a record low and shake out of the comfort zone. He has also flagged that Nifty's return in dollar terms is 0 for the year. So yes, that's the latest comment coming from Uday Kotak on the weakening rupee. But now let's refocus and talk about JSW Steel, which has announced that it has entered into a strategic 50:50 joint venture partnership with Japan-based JFE Steel Corporation. Now, the equity value of the joint venture is estimated to be around 31,500 crore rupees. My colleague Anurag Joshi caught up with Jayant Acharya, the joint MD and CEO at JSW Steel, in an exclusive conversation to understand the synergies from this latest deal. Let's take a look.
So JSW Steel will be significantly strengthening its balance sheet. We expect about 37,250 crores of deleveraging gross number, and about 32,400 crores of cash coming in. It'll help us accelerate our growth path in terms of the direction which we have given you, 50 million tons by 2031, and we are looking beyond as to how we can fast track our capacity expansions in India, in our brownfield assets, and in Odisha, which we are building up in a modular fashion.
Sure. And there will be a 32,000 crore non-debt cash infusion into JSW. How are you planning to use those funds, that cash flow coming into your balance sheet, and how does the deal generate that?
So it will be a combination of deleveraging and capex in the near term. So that's something which we will work on and then finalize.
When are you confident of achieving all the regulatory clearances and setting up the joint venture with JFE for the transfer of Bhushan Steel business?
So part of the transaction will get completed by March, we hope by March 26, subject to regulatory clearances from various authorities. Once the combination, the merger of PSL with JSW Steel is finalized, that may take a few more months. We expect to close that in the next financial year.
Right. And you're targeting a steelmaking capacity of 50 million tons a year. That is by FY31. How does this joint venture help in that objective? And is there a possibility you may surpass your goal and achieve the target before FY31?
So the way I think we would like to look at it is that we are very excited about the opportunity which India offers. I think the capex which the government of India is put in place in terms of growth every year over the last few years has been giving the necessary tailwind to the industry to be able to set up capacities to meet the demand. The additional story, I think, which is yet to play out and which is very positive is the consumption story. The GST reform which was undertaken has been a big benefit to the consumer. It has also been a big sentiment booster because cut in interest rate, cut in income tax, I think along with the GST benefit is all playing into a much bigger consumption story. That will play out both in urban and rural. We are also seeing the construction, the technologies are changing, so you will see more of mechanized constructions coming in, especially in urban. That will not only consume direct steel in terms of the construction, but it will also have more of equipments like where we will supply to the yellow goods. So we are seeing a good kind of a pathway ahead as India grows. I think it's a multi-decadal story which we see in India.
What are JSW Steel's capex plans, and also can you tell us more about the tie-up with POSCO? I mean, what are the goals there? What are you looking to achieve?
What are JSW's?
Yeah, goals in terms of the capex plans.
So the capex plans which we have already given you by as of end of September, we already have about 70,000 crores of capex in place for 43 million tons of capacity which we have set out to put in place. That's already in the pipeline, 2 million tons in Vijayanagar by augmentation of the blast furnace and some debottlenecking, and another 5 million tons of capacity which is under construction in Dolvi.
All right, so that's the latest coming from JSW Steel about their latest joint venture. But on that note, we'll slip into a very short break. Be right back with more news and updates on the other side. second quarter of this fiscal. As far as the numbers are concerned, our revenue that saw an increase of 5.6% on a sequential basis, whereas EBITDA that saw a very sharp jump of 69%. Margins, they also improved very sharply to 11.6% level. That's compared to 7.2% in the last quarter, that is Q1 of FY26. PAT, that has also come in at 6 crore rupees. That actually marks the second consecutive profitable quarter for Pine Labs. So yes, yet another very positive development. If you take a look at what's happening on the operational front, the company delivered some big milestones. Platform GTV that crossed $48 billion. That's up 92% on a year-on-year basis. Merchant base crossed 1 million. International revenue, that's now 17% of business. And there's also strong growth momentum in online payments. Affordability, issuing and acquiring, all of these have risen above 30% on a year-on-year basis. Meanwhile, the in-store POS business that also remains steady as Pine Labs pivots towards the software-led model. So yes, yet again, a very positive show over there. Other than that, the company has also launched Tap and Pay, allowing merchants to accept contactless cards directly on their smartphones. This with regulatory approvals and testing currently underway. On the guidance front, very strong guidance is what they've given. They expect 20 to 25% overall revenue. EBITDA margins, they expect a rise to the 22 to 25% level. Online payments, affordability and fintech infrastructure, that's expected to grow 30 to 45%. Other than that, they've said that issuing and acquiring, that's going to expand 35 to 40%. And lastly, international business, that could also grow 30 to 35%. So yes, overall a very solid quarter with improving profitability, stable execution and strong visibility coming from Pine Labs. So yes, that's the latest update on Pine Labs, and on the back of the strong quarter too, we'll see how the stock reacts today. But now let's shift focus to some macro data. Now all eyes are going to be on the Reserve Bank of India this week, which is widely expected to cut interest rates by 25 basis points. Now a Reuters poll shows nearly 80% economists are eyeing a rate cut, followed by a long pause going into the next year. Now what all do we expect from this MPC meet? Mitali is back with us to take us through all of the details.
Right, so all eyes are on the upcoming MPC meeting as the markets are actually braced up for another possible policy move by the Reserve Bank of India. And according to the Reuters poll, nearly 80% of the analysts actually expect a 25 basis point rate cut, which could bring down the repo rate to 5.25%. Also, now this expectation is strengthened as the RBI governor has given his recent remarks stating that the current economic data also suggests a room for further rate cuts. Now let's have a look at the RBI's updated projections after the Q2 FY26 GDP numbers came, and now the growth is expected at 6.8% for FY26, moderating slightly to 6.4% in Q1 FY27, while for inflation it is projected to fall down sharply to 2.6% before stabilizing at 4.5% in Q1 FY27. If you talk about the global factors, the global risk still persists and the investors seem cautious around the US tariffs, 50% of tariffs that the US has proposed. After the FIIs seem to pull out $17 billion from the Indian market so far this year. Now, looking at the past trends that the RBI's rate cuts is considered, so RBI has held rates steady since August after delivering a 100 basis point cut in the first half of the year. Also, softening food prices and adjustments in the GST slabs have brought down the inflation to just 0.25%, creating a more comfortable policy environment. If you look at the current rates for the policy rates, the repo rate stands at 5.5% with CRR standing at 3%. Now, the interest rate trend for 2025. So rates have been gradually moving lower during the year and starting at 6.5% in January, slipping down to 6% in April and further easing down to 5.5% in June. And from there, we have seen a stable rate until September. If you see India's GDP trend, the growth has been picking up momentum from Q1 FY25. If you see, the numbers were around 6.5%, which have come up to 8.2% in Q2 FY26. So the recent numbers show a strong acceleration in growth, which may give the MPC confidence even with the rate cut. Now you're talking about the IIP trend. So industrial activity, however, presents a mixed picture with IIP slipping to just 0.4% in October, pointing to volatility in manufacturing and output. But overall picture, if you talk about, we see that the domestic inflation has been softened, growth holding is strong, and global trade risks still loom. All eyes will be now firmly on the MPC meeting, with the street strongly expecting a 25 basis point rate cut.
All right, thanks, Mitali, for that update. We'll watch out for how that turns out, the RBI policy announcement tomorrow. But let's move on and take you through what's happening in the primary markets. Now, Meesho IPO is open. Let's start with that. It's open for subscription, and yesterday was the first day. The QIB portion of the IPO has been subscribed 2.1 times, NII 1.8 times, whereas the retail portion that has received subscription of 3.8 times. So yes, the total subscription that the IPO so far has received is 2.4 times, so very healthy across categories. Similar is the case with AQS IPO 2. Yesterday was the first day. QIB portion has received 0.7 times of subscription, NII 3.4 times, and retail category that has received 11.5 times subscription. So yes, very healthy across categories. Employees also, the employee portion of the IPO that has received a subscription of 6.7 times, and the total that stands at 3.4 times. So yes, across categories, very healthy. And lastly, there is Vidya Wires. This one is also open. Yesterday was the first day of the subscription. QIB portion that is received with for 0.5 times, NII 3.4 times, whereas the retail portion that has been subscribed 4 times. And yes, so the total stands at 2.9 times for Vidya Wires. So all of the 3 IPOs, AQS, and Vidya Wires, all of them have received very healthy subscription across categories. So yes, that's the latest from the primary market. But with that, we're completely timed out on this edition of Market Cafe. I'll take your leave, but don't go anywhere. The market is coming up next.